These two stocks are undervalued even though the semiconductor industry depends on them. Solstice and Qnity are key suppliers to the hottest sector in this market, and because they only started trading recently, they haven't been properly valued yet, but once the market finally pays attention to them, they could take off fast. Suppliers behind the semiconductor giants can be just as profitable as the major players. Right now, everyone focuses on Nvidia, TSMC, AMD, and yes, they're incredible companies. But they're also massive, widely followed, and in many cases already priced for perfection. That means their upside from here is more limited. Meanwhile, the companies providing the essential tools, materials, and technologies needed to produce these advanced chips have been overlooked and undervalued. Historically, in every major tech cycle, cloud, mobile, and now AI, suppliers eventually catch up once investors realize how crucial they are. Think about it. Before a chip is even designed or manufactured, the suppliers get paid first. They benefit from the entire industry, not just a single product. That's why Solstice and Qnity stand out right now. They operate behind the scenes, but the semiconductor boom cannot move forward without them. And because they only recently began trading, the market still hasn't priced in the real potential. Qnity and Solstice are different from almost every other supplier in the semiconductor industry. And it's something we talk about all the time on this channel. They're both fresh spin-offs. These companies used to be buried inside two massive industrial conglomerates, Honeywell and DuPont. Within those giants, they were just small divisions producing specialty materials for the fast-growing AI and semiconductor markets. Here's the problem with being stuck inside a huge conglomerate. Their growth gets buried under the slower, heavier performance of the parent company. And when a division starts growing much faster than the rest of the business, big corporations usually do the same thing. They spin it off. That's exactly what happened here. Because their AI-related materials businesses were expanding rapidly and delivering strong results. The parent companies decided to separate them into independent companies with their own balance sheets, their own management teams, and most importantly, their own true valuation. Historically, many spin-offs outperform the market because once they're independent, investors can finally see the real value of the business. This is why these companies stand out. They're not only critical suppliers to the hottest sector in the market, they also come with a classic spin-off setup that often leads to strong performance once the market discovers them. However, before that jump happens, every spin-off goes through a rough phase, and Qnity and Solstice are no exception. Both companies started trading recently, and from day one, their stock prices have been sliding. But here's the key, that's completely normal for a spin-off. When a big corporation spins off a new company, every shareholder of the parent company suddenly receives shares of the spin-off in their portfolio. But most of these investors never ask for them. Many are large institutions with strict rules. The spin-off might be too small. It might not fit the fund sector strategy. Some funds simply can't hold spin-offs because their internal policies don't even know how to classify them. And overall, big institutions prefer stability, not newly listed companies. So, what do? They sell immediately, not because the business is bad, not because the fundamentals are weak, but simply because the shares don't fit the rules. This automatic selling creates a temporary drop during the first weeks or months after a spin-off, a drop that has nothing to do with the company's real value. And this is where the opportunity shows up. Spin-offs are one of the few moments where retail investors can get an edge over big funds. While institutions dump shares mechanically, retail investors can step in and buy fundamentally strong businesses that are artificially undervalued. For Qnity and Solstice, this early sell-off isn't a red flag. It's just part of the classic spin-off pattern, the same one we've talked about many times on this channel. That often leads to a strong rebound once the forced selling ends and real demand kicks in. Just look at SanDisk. It was spun off in February and had a rough start. For almost 3 months, the stock kept falling, nearly 40%, very similar to what we're seeing with Qnity and Solstice. But once the forced selling dried up, the stock didn't just recover. It skyrocketed more than 600%. Why such a massive rally? Because SanDisk designs and manufactures high-performance flash memory products, and modern AI models require massive amounts of ultra-fast storage. As AI demand exploded, so did the demand for SanDisk technology. But here's the real point. AI reshapes every part of the semiconductor ecosystem. Chips, materials, specialty processes, packaging, everything. And this is where Qnity and Solstice come in. These companies produce critical specialty materials for the semiconductor and the AI supply chain. Their peers in the same segments are already trading at a premium valuations. A clear sign of how valuable this niche is becoming. Qnity and Solstice simply haven't been priced correctly yet because they're new, recently spun off, and still moving through the forced selling phase. But once that phase ends, The AI boom and the semiconductor demand cycle could push them the same way it pushed SanDisk, potentially hundreds of percent, because both companies operate in segments with deep structural demand. Before we break down each company individually, make sure to subscribe if you want more content on spin-off opportunities and the unique advantages they offer to retail investors. Now let's continue. First, let's talk about Solstice. Solstice provides specialty chemicals used across multiple industries: pharmaceuticals, defense, construction, and of course, semiconductors. This diversified demand gives the company a stable and resilient revenue base. But the real acceleration comes from the semiconductor boom. Because of this strong growth, its parent company, Honeywell, spun it off on October 30th, creating a new independent company. And just like we explained earlier, the stock immediately went through the classic spin-off dip, falling about 15%. But here's the interesting part. The fundamentals look better than the share price suggests. Solstice has delivered consistent revenue growth over the past years, while many of its direct competitors have reported negative growth. Its profitability metrics are also standout. EBITDA margin 25%, return on equity 20%, higher than most peers. Debt to equity only 13%, extremely low for this sector. This is the profile of a company with a strong competitive position and control risk, yet the market isn't valuing it that way. Right now, Solstice trades around 44 per share with a PE ratio of 20. That might look fair, since the sector median is around 21. But when you combine its above-average growth, stronger profitability, and much lower leverage, Solstice actually appears undervalued compared to its peers. And remember, we're still in the fourth selling phase of the spin-off. Once that selling pressure fades and investors finally shift their attention to the fundamentals, Solstice could quickly catch up to, or even surpass, the valuation of comparable companies in the semiconductor supply chain. Take Balchem Corporation, for example. It has similar metrics, yet it trades at a PE ratio of around 33. Now let's move on to Qnity. I already covered this company in my last video, but that was before it actually started trading. So let's take a look at what has happened since the spin-off. Qnity was released by DuPont on November 1st, and just like Solstice, it went straight into the fourth selling phase. The results? The stock is down about 20% since day one. That might look alarming at first, but again, this is exactly what happens with most spin-offs. The fundamentals didn't suddenly get worse. Big fans simply sold because Qnity doesn't fit the rules. Right now the stock trades around 75, with a PE ratio of 20, while the average for its sector is 28. And what makes this even more interesting is how strong the numbers are. Qnity has EBITDA margin 30% versus 10% for its sector, return on assets 6%, triple the sector average of 2%, a strong balance sheet, solid income statement, and healthy cash flow. I broke all of this down in detail in my last video, and nothing has changed. In fact, the deal has only made the valuation more attractive. With this level of profitability and financial strength, it's only a matter of time before the market reprices the company closer to its true value. Once the fourth selling ends and the real demand kicks in, Qnity could move sharply upward to match the valuations of other high-quality semiconductor suppliers. So, what am I doing right now? Well, Solstice and Qnity are in almost the exact same situation. Similar sectors, sizes, and both recently spun out from huge industrial companies. I started buying them before they were released. As I explained in another video, if you buy shares of the parent company, you're entitled to receive shares of the spin-off once it begins trading. That's how I got both Solstice and Qnity, by holding DuPont and Honeywell. But even after the spin-off, I've kept buying. Of course, I save the main buying for when the companies are clearly undervalued. And right now, with Solstice down about 15% and Qnity 20%, both stocks are getting very close to what looks like their bottom during this sell-off phase. However, and this part is important, if you're thinking about investing, you should always do your own research. Spin-offs can fall even further before they recover, or the market might take longer than expected to recognize their fair value. That's why it's so crucial to understand exactly what you're buying, so you don't panic sell too early or hold too late. On this channel, we break down these opportunities step by step, so if you want to learn how spin-offs work and how retail investors can take advantage of them, make sure to subscribe and like the video. It really helps and lets us keep bringing more insights into this process. Have a great day and see you in the next one.